Crypto and taxation is a really hot topic at the moment, and we want to dive into that topic today. But first, crypto is a really broad term encompassing various concepts. Do you actually think it's fair to consider all crypto under one taxation regime?
First of all, it's a pleasure to talk about taxation, which is a special topic, especially in these challenging times internationally, but also in consideration of the European changes recently. And yes, to answer your question, of course, it makes sense to differentiate between Bitcoin, which is rather like money or a commodity, and other altcoins. Okay, so altcoins are highly centralized in comparison to a very decentralized platform like Bitcoin. And when it comes to altcoins or other cryptos, there is differentiation required between, in my opinion, between utility tokens, gas tokens, and stablecoins in particular. These require different consideration and a different regulation, and also a different taxation regime, in my opinion, certainly, because Bitcoin is like gold, primarily used to save, like a saving technology, which is not necessarily the case for altcoins, which are, like they are saying it themselves, considering themselves as a payment technology, not as a store of value technology necessarily. So yes, it makes sense to differentiate between Bitcoin and cryptos.
Germany's coalition proposal protocol revealed plans to actually remove the 1-year exemption rule for crypto gains. So they plan to put capital gains tax on all crypto and Bitcoin. How significant is that, and what does it actually mean for long-time holders?
Yeah, if you consider Bitcoin as a savings technology and not as a speculation, like most Bitcoiners do, it's a disaster for everyone trying to actually save money in terms of having a remaining or stable value in terms of purchasing power, to save that in terms of an inflationary environment like the fiat currencies, stable like US dollar or euro. And yeah, it's a disaster. If you want to save money, you certainly are disencouraged to really save in Bitcoin by applying these plans to up to 30% capital gains tax. Actually, the recent coalition in Germany plans not only to lift, like you said, lift the tax exemption after 1-year holding period, they also want to increase the capital gains tax from 25% to 30%. To be fair, it is not yet in the coalition contracts between the major negotiating parties right now. This is true, but it is already in the coalition discussion protocols. So yeah, we have to consider that and take that seriously if the major elected parties in Germany really consider an increase in taxation, especially not only for cryptos, but also for real estate investors and stock investors. We really see a push towards capital gains tax and increasing tax levels.
Yeah, absolutely. Do you actually see a wave of similar taxation reforms across Europe? Are governments coordinating these efforts?
Yeah, indeed. So what we see is consolidation and standardization, which is intended amongst European member states. Okay, so what we have seen 2 years ago was Austrian tax regulators lifted the tax exemption after 1-year holding period. They completely lifted. Last year, we've seen Italy increasing capital gains tax to, I think it's more than 40%, 42%. And this is changing amongst the whole European area. And the idea is to provide a standardized framework, like having a consolidated framework amongst all member states regarding taxation of crypto assets.
So yeah, interesting. So we see several countries proposing stricter Bitcoin and crypto taxation. What do you actually think is the key motivation behind those changes?
Satisfying drastically increased fiscal demands due to wars and also trade wars.
Okay, can you elaborate a little?
So we see a physical war in Eastern Europe. We see an emerging trade war regarding tariffs with the transatlantic relationship on up to 25% tariffs. This is nothing else than a trade war in the end, right? Because obviously, if that is applied like it's intended and communicated, you will see a spiral of tariffs on tariffs, and which in the end, there will be only losers, right? Because there will be so much tariffs and so much protectionism that it will end in a trade war-like situation. And I really see that there's high demand in fiscal requirements. What does it mean in simple words? Our nation states, especially in the European area, need more money. And crypto is obviously one of them. And Bitcoin crypto had been always a sweet spot in terms of, okay, quite innovation friendly. There's after 1 year holding period, similar to gold, by the way, there is no taxation on that. And it seems to be like easy pots to tap in and to increase the already very high taxation burden. I think it's, from an OECD perspective, the second highest tax burden of all OECD countries is Germany already, right? So this is a very high tax burden. And we don't, in Germany, I would say we have a spending problem, not an income problem. So the accumulated overall tax revenues are more than 1 billion per year, right? So there's not an income problem, there's a spending problem.
So yeah, and with this increase in taxation, how are investors reacting? What do you think? Are we going to see any change in behaviors? Are they relocating? Are they selling quicker? What do you think?
Yeah, two things. So I've spoken to a lot of Bitcoiners and also crypto holders who are highly likely to actually remove if they hold a larger position. But all others will sell their assets, realize tax-free gains first, and then rebuy. Mm-hmm. So in the end, there is no real gain to be expected from a fiscal perspective, because people certainly will realize tax-free gains first and then simply rebuy, and additional gains, or additional gains after this taxation regime certainly will be under this new tax rule, if that comes, if that is part of the new coalition contract. And they will actually also drive major tech players. Bitcoiners are highly tech-savvy people who usually come on a high degree of education, high level of income, which are definitely needed for increasingly digitalized society. You need this expertise, obviously, right? In the country, you don't want to drive them out of your country, and which is actually what we see here.
Yes. And that's actually contrary to what, for example, the US is doing, right? So there's also the upcoming DAC8 directive. What role does it play in shaping the future in crypto and Bitcoin taxation?
The directive on administrative cooperation aid, which is in legislation from 2026, is intending to have transparency amongst all EU nation states. And in simple words, the EU wants to know who bought which asset, whether it be Bitcoin, whatever, who bought that from any crypto assets service provider. So the CARF, the crypto asset service provider, they are obliged to report all transactions for all clients, and they are also obliged to do fully fledged KYCs, know your customer, that you have entered your ID. And this is also, by the way, relevant for most DeFi, decentralized finance transactions. May you consider Bitcoin DeFi or any other DeFi ecosystem. So it's much, much broader, obviously, than the MiCA regulation. So that's basically what is upcoming. And the idea is to standardize reporting, and that basically then they know what you bought.
So yeah, and there's also the OECD crypto assets reporting framework. How does that relate?
Yeah, the CARF is basically this very similar, if not the same intention, on a almost global scale. So it is directly integrated, and the idea is to have from all, not only all Western countries, but from all major countries, have a very similar and exchangeable like format and record keeping and transparency, who bought what at which platform for which price.
So let's get one step further. There's also something called the EU Asset Register, the EU Wealth Register, so to say. How does that relate to that?
Yeah, so the EU Wealth Register, or European Asset Registry, how it's officially called, is right now in a feasibility phase. It's not yet out. The European Union checking whether that's an option, how that could be implemented. There are a couple of parliamentary questions that has been filed to this European Asset Registry, and the intention is to not only consolidate all crypto assets in one registry, like the aforementioned CARF initiative and the DAC8 initiative, but also all other wealth and assets. So not only cryptos, but also they include wealthy cars, alternative investments like arts, images, etc. Not only precious metals like gold, silver, etc. Stocks, obviously, real estate registered. So the intention of the EU is to get a registry, a single record or single ledger of all your, all 450 million inhabitants or citizens, to create one centralized asset registry. And especially in consideration of an EID, electronic ID, which is obligatory from 2027 on, also with the CBDC, central bank digital currency, which is a digital euro, basically. We see that likely from 2028 on. This is a constellation that we see right now. And these three together, this might be dangerous because obviously people always say in the wrong hands, this would be very dangerous. Yes, certainly we need national regulation, but in my opinion, it is dangerous to consolidate that on a level that high in Brussels, because we have no checks and balances when we have these types of power consolidated in Brussels alone.
Yeah, so there might be an agency problem. And as a business and as an individual, you might want to prepare. You may want to prepare for the upcoming reporting requirements, for the compliance obligations. Do you have any suggestions?
As an individual, there's the option to buy assets on peer-to-peer platforms. And since it's a peer-to-peer platform, this is usually done on a direct relationship basis. So I sell you my Bitcoin and I buy you Bitcoin, and this is a directly settled. These platforms, oftentimes they come with no obligation to do KYC. So you don't need an ID for that. You can simply exchange in a free trade. This is what individuals can do. As a business, I would rather recommend to see, okay, taxation will be even more complicated in the future on a European level. So it really makes sense to use a dedicated tax tool. There are a couple of reporting tools out there that can track all purchases, all sales, etc.
Yeah. And what do you actually think the rising taxation does to Europe as a location for innovation and entrepreneurship? Do you actually think that capital will be pushed away to more favorable locations like the US, Singapore, or Dubai?
Let me answer this question on a global scale, right? So there's a reason why there is no global payment startup like PayPal in Europe. There's a very simple reason, because from a regulatory perspective and also from a technology perspective, back then, it was not possible to create these kind of incumbents from a European Union. Okay, you may argue otherwise, but we can simply consider there is no European, German, French PayPal. Okay, there's a couple of smaller initiatives, obviously where there are payment startups in Germany and France, of course, but there is no global PayPal, and this is a very simple reason. So that's the one side. Yes, and I would say we as Europeans, if we actually have these implications of stricter rules, we drive out innovation. This is clearly the case. As tech founder myself, I'm highly mobile. I don't mind whether my business is in Dubai or in the US. It's very simple to actually move assets, very simple to move your company or found a new company anywhere. And this kind of taxation obviously drives out innovation. And to the second part of the question, yeah, people will go to the US, will go to Dubai or Singapore and other more attractive spots. No? And well, if you cannot move personally, you always can found a company or a foundation abroad.
Yeah, that's interesting. It's counterproductive, right? And what do you think is the risk this poses to undermine the utility of crypto as a payment method?
Yeah, indeed, because every sale is a taxation event. So whenever you exchange that for good, whatever it may be, Bitcoin or any other altcoin, whenever you exchange that for a good or a service, you have a direct taxation event. So how would it not be complicated or to be seen as innovation hindering? If you would have the same issue for euro payments, that every payment directly implies a new taxation event, it would be impossible to pay with anything.
Yeah, and you as an entrepreneur in the space, what would you actually like to see to strike actually a better balance between innovation and taxation?
Yeah, so two things. So on the first hand, people buy Bitcoin and cryptos with already taxed money. So there is no need to have another tax on top of that. Okay, so the nation states already earn their fair share when people bought that. They use that. There are exemptions. There obviously are speculators, yes, but the majority of people are using that for their long-term savings, using that as their pension enhancement, for instance. Yeah, and this is in particular relevant for savings technologies like Bitcoin. Okay, use that similar to gold. Had been done for hundreds of years. You simply hold gold and hold that for 100 years, and after 100 years, it's still the same purchasing power, which is not the case for fiat currency. That's the reason why people buy gold. This is the same reason why people buy Bitcoin. So that's one thing. And on the other hand side, I really want to see an environment-friendly and not too over-regulated environment that startups can strive. We see massive deregulation from the US, which is certainly required to adapt from a European perspective. Because, as I said already, innovation is stifled by too much regulation.
Do you have any further recommendations?
Yeah, it will be a tough environment to be a Bitcoin crypto holder in the next couple of years, and not unexpected, to be honest. And yeah, it probably makes sense to get into self-custody, to be 100% self-reliant. So this is what I always recommend, especially to individuals.